What's up everyone, it's Scotty with MoneyVest. In this video, wanted to talk a little bit about the 10-year yield, the TIPS, which is inflation protected securities, and also talk about a very interesting report that came out today, which basically suggested that the 10-year yields are going up because Nvidia stock and Nvidia earnings expectations are going up, and Nvidia is really what's driving the rise in yields. So I wanted to break that down. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the buy and sell alerts, options alerts, trade ideas. I did open up a few more spots if you are interested in joining, and there is a 16% annual discount also available until the end of this month as well. So links are going to be down below if you're interested in joining. So this right here was the catalyst. So rise in treasury yields is almost entirely due to one factor, is what this strategist is basically talking about. And that one factor, here it is: stronger economy. The market is expecting a stronger US economy and a potentially soft landing scenario. And that's exactly why the yields are going higher, because they're expecting GDP growth and productivity to continue in the US. So the recent rise in long-dated treasury yields boils down to mostly one single thing, which is the higher real rates resulting from changing expectations for US economic growth, is what Joseph Kalish, chief global macroeconomist at Ned Davis Research, is also talking about. And he says that this reflects the intermediate part of the treasury curve, known as the belly, has trended higher as traders and investors factor in prospects for a stronger US economy beyond the next few years. And the reason for that basic analysis is the discrepancy between the actual treasury yield and the inflation protected treasury yield, right? Which is known as the TIPS. And TIPS are the real rate after inflation. So if this number is not going higher, that basically means that that market doesn't want the additional return to compensate for higher risk or a higher inflation rather. But this right here is the treasury yield, obviously much higher than the actual TIPS rate, suggesting that the market and investors are anticipating a stronger economy and maybe even a soft landing, no landing scenario without the need of a recession. So this right here is the same example, same chart, 10-year versus the 10-year TIPS, and you can see that discrepancy, you can see that sort of divergence there between the two, because again, you go back to 2019, 2020, it was almost very similar because the expectations for inflation were really high, and of course the real rates were negative for majority of 2021, 2022, and it's not until 2023 that we have seen this number turn positive on the back of lowering inflation and higher yields. So moving forward, you'll notice that ordinary treasury yields tend to rise based on a range of factors such as the possibility of higher future inflation and investors' demands to be compensated for that risk, exactly what I mentioned. This time around appears to be a bit different. Real rates as measured by yields on treasury inflation-protected securities, so TIPS, reflected the market's view of how the economy is performing after subtracting inflation, so there's that divergence. In other words, they present a purer read on how the US is likely to do when inflation is not a factor. And right now, real yields are rising on the strength of recent economic data, and investors hold out some hope for a soft landing or scenario in which inflation comes down without the need of a recession or a major jump in unemployment or even no landing at all. So bond yields have come a long way in a short period of time, is what Kalish noted, and he said that nearly all the rise has been due to a higher real yields, though an increase in the supply of US government debt is also playing a contributing role. I think that we're kind of underestimating. Supply of US government debt is also playing a contributing role. I feel like that's playing a very significant role. I think the US economy, yes, it's growing at a moderate pace, but that's also part of the reason is because a lot of the money has shifted from public sector over to the private sector. Companies, individuals, businesses, everyone is very well strapped with the amount of cash they have or were given cash during the COVID pandemic. And of course, all these stimulus checks, lower interest rates, being able to borrow, invest, and spend, that has really put them in a very strong position. And I think it's going to take time until all that kind of plays out and kind of ripples through the economy. And of course, we start to see some depletion in the actual savings rate. Savings rate is still pretty low, 4 to 5%. So I don't think it's going to go on forever. And I do believe that this right here is a very significant contributor for why the yields are going higher, which is the new issuance of debt that's happening from the Treasury Department. Now, one catalyst, which was absolutely very ridiculous and stupid from Ben Emons of New Edge Wealth, says you could ask who is really running the show, Jerome Powell or Jensen Huang. Amazingly, it may not be Powell, but Jensen Huang, who is driving Fed expectations. So this right here is basically what he said. He said it starts with the idea that the Santa Clara, California-based chip designer, which reports their numbers tomorrow, so after the bell tomorrow, very, very important day for Nvidia and of course for the market. He says acts as a bellwether for AI capex, so AI-related capital expenditures that are likely to boost productivity across the U.S. economy. And in the bond market, a surge in AI-related expectations is translating into higher real yields, which reflect inflation-adjusted growth in gross domestic product and productivity as well. So what he's really saying is Nvidia represents artificial intelligence, which represents capital expenditures in AI, which represents likely to boost productivity in the US economy, which means higher yields because of a stronger economy. That's a very, very big leap. Like, I'm not gonna lie, that is a very, very big leap in terms of what the market might be looking at. This right here is what he's looking at, the Nvidia's second quarter EPS estimate, and of course the probability of a hike as well. So as the expectations have gone up, apparently probability of a hike have also gone up, so there's a correlation to be drawn. This right here is another chart which basically goes over the maturity of the Nvidia corporate bond, which is going to mature in 2040, so in the next 17 years, and the yield on that Nvidia corporate bond versus the 10-year real yield have been both moving in the same direction, apparently, according to these charts. But I've got one more chart to show you to help you make your decision. This right here is another chart, right? The orange line is the 10-year yield. The 10-year yield is obviously moving higher in tandem with the blue line. And guess what the blue line is? It's orange juice. It's the price of orange juice. So in my opinion, these correlations, yes, they can look pretty intelligent and be like, oh yeah, Nvidia's corporate bond, if the yield is going higher, the 10-year is going up. Markets work in that way, that there you will see a lot of assets, a lot of things, yields, corporate bonds, treasury yields, they all kind of moved in tandem together when there is a catalyst getting priced in. So that doesn't mean that Nvidia is driving Fed policy. This right here is, again, is orange juice driving Fed policy? Is the price of orange juice putting up upward pressure on the 10-year yield? In a very, very indirect manner, sure it is, but you can't, that's a big leap, kind of looking at, just one stock, one company kind of driving Fed policy, driving interest rates. Yes, it definitely plays a much bigger role now. It definitely has a much significant position in the market because it's a $1 trillion company, because, it's kind of like a leader in AI. But I think the Fed really focuses and really is, going to be focused on inflation more, bringing inflation down, than looking at, whether the GDP is growing on the back of Nvidia's AI infrastructure and there's more capital spending. Sure, there's something that there's going to be Federal Reserve is going to look into, but that's not what's driving the actual Fed policy. So just wanted to go over that. Tomorrow is a very, very important day. So if we actually come over to the S&P 500, you will notice that we did get rejected at those moving averages. We are somewhat forming a little bit of a head and shoulders pattern right now for the S&P as well. So resistance is going to stay put at 44.50, with the support staying put at 43.33, 43.30. And of course, we also do have the NASDAQ, which is also getting rejected at those moving averages. And we do have a resistance all the way up to as much as 13,800, kind of in line with this previous resistance. There is a possibility of a potential head and shoulders for this one as well. Support level is going to stay put inside this green rectangle, sitting roughly at 13,200. So we'll be ready for Friday. I'll be live streaming Jerome Powell's speech, but of course tomorrow we've got very important Nvidia earnings. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining. There is a 16% annual discount available for just about 7 more days. So if you want to take advantage of it, it's going to be here. I opened up a couple more spots. We'd love to have you on board. We've got new members joining every single day. You can ask anyone. Everyone's absolutely satisfied. Fantastic reviews. So again, link's going to be down below. Happy investing, and I'll see you all in the next video.